Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. Very excited for this episode. Always excited, but there is so much happening in markets at the moment. It's hard to keep up. It's hard to keep it into a short podcast, but we are going to do our best. We're going to cover the news of the day, what's happening with the Trump trade, what's happening with Aussie house prices, what's happening with self-driving cars. We're going to answer a listener question from Josh, and then we're going to be joined by Mr. Beat Up. Yes, he is back. He's going to bring us a stock that might be down, but is certainly not out and may be poised for a rebound.
Wow.
Yeah.
Big news. Well, can't wait for that, but let's hit it.
News and markets.
No surprises that we're starting with Australian house prices, but the news this time, Ren, is not that they're always going up.
Yes.
According to Core Logic, the latest data shows that nationally, 1 in 3 suburbs have seen house prices fall in the past year.
Yeah, particularly acute in the major capital cities. In Melbourne, 76% of suburbs, so just over 3/4 of suburbs, have seen price falls in the last 3 months. In Sydney, it's 40%. So 2 in 5 suburbs have seen price falls in the past 2 months. Now, it's not every capital city. On the flip side, every single suburb in Perth grew over the past 3 months. It's living through a bit of a boom at the moment.
Yeah. So good news for first home buyers, I think, if you're
in Sydney or Melbourne.
If you're in Sydney or
Not if you're in
Not
Perth.
if you're in Perth. Not if you're in Perth.
Adelaide and Brisbane are also growing strongly. Yeah, I mean, like the different speeds, different markets are growing at different times. I anecdotally have certainly seen, it feels like there's a lot of supply at the moment around my area, a heap of for sale signs. So I imagine that's a part of it.
Yeah. Let's move on. Well, I can comment to that.
Well, yeah, I thought there was maybe something to say.
I also think that how do I say this? I think that the flow and effect of interest rates is now really starting to kick in, if that makes sense. Like a real delay here. It feels like Sydney particularly, that price affordability is at its maximum.
And that's what the experts always say. They say there's like a 12 to 18 month lag with interest rates. And then just because of human nature, like people will cut all their expenses before they stop paying their mortgage. So, there's been that lag effect. People really start to feel it. People really stretch their household budget. And now they're like, I just need to get out. So the timing makes sense. Yeah.
I was speaking to his buyer's agent yesterday, and interestingly,
you're looking to buy again?
Yeah, back in the market. No. And interestingly, he said that if you were to compare apples with apples now between Sydney and Melbourne, same house, like try and say the same suburb, if that makes sense, they're seeing up to a 53% differential in price.
Right. Wow.
Yeah,
Melbourne being cheaper.
Yes. Yeah. So as he was saying, for first home buyers, great. For investors, obviously not so great, but opportunity in Melbourne.
Could be the time. That might be what Mr. Beat Up's going to come and tell us about.
Melbourne house prices.
Melbourne house prices. But Bryce, we should move on because there's a big story emerging out of the US. It's been bubbling along for a couple of years, but I think we can start to say that the era is finally here. The story has emerged. We are now living in the era of self-driving cars.
We are. So Alphabet's self-driving car division, Waymo, has made its autonomous vehicle ride-hailing service available to the general public in LA.
Yeah.
So they first launched their Uber-like robotaxi service in Phoenix in 2020 and then expanded to San Fran. But now those in LA are going to get the ability to jump in a self-driving taxi.
Yeah. So Waymo, it self-reported that it does more than 150,000 trips each week in its self-driving cars for its Uber-like robotaxi service. Its wait list in LA was 300,000 people strong, and they've just been testing it. And the criticism of Waymo was always Phoenix was kind of like a controlled test site, and it wasn't real, it wasn't scalable.
Yeah.
but now they're starting to expand. And I feel like if you can nail LA, one of the worst cities for traffic in the world, like you're well on your way. So
it's just a crawl though.
It is just a crawl. It's a crawl and a sprawl. But look, Waymo isn't the only story here. Elon Musk's Tesla, always one for big announcement and timelines that he doesn't always meet, but he said that they're going to launch their Cybercab robotaxi service in Texas and in California next year. But the one that I'm most excited about, Zoox. You heard of Zoox?
I have.
Yeah. So Zoox was an Aussie startup, an Aussie self-driving car startup, got bought by Amazon a few years ago. Zoox has said is preparing to launch in Las Vegas and San Francisco next year. So we're going to have multiple competing self-driving car apps to choose from, robotaxi services to choose from.
Love it. Well, hopefully they can get across to Australia.
Yeah, when I say where, I mean people in the US.
Yes. You wouldn't want to be a private car driver.
Just because you're going to get competed away.
Yeah. I can just see all those people that, all that class of people that have cars, pick them up and drive them everywhere.
Yeah. Well, imagine if you invested in a taxi medallion when they were 6 figures and then the value of them got gutted by Uber and now this is going to come. Yeah.
Anyway, we'll close out. We can't finish a news segment without talking about the Trump trade because it is certainly still in play. But this time we want to revisit an ETF that we spoke about a couple of months ago called Destiny Tech100.
Yeah, I think this has actually been the biggest winner from a pure percentage growth since the election.
Yes.
Last episode we spoke about the private prison stocks both being up around 75%. And you compare that to Tesla being up about 40%, a lot of the cryptocurrencies being up between 30 and 40%. They were some of the really big moves that we saw. But this is up since election day, 190%.
Yeah. That's pretty incredible.
So
a reminder of what it does. It's an ETF that is designed to hold up to 100 of the world's biggest private tech companies.
Yes.
So some of the big names include Stripe, Epic Games, Plaid, Revolut, Flexport, Impossible Foods, Axiom Space, you name it, it's in the portfolio.
Well, you name it. But the one that I was surprised isn't in the portfolio, Australia's own, Canva.
I think
it's not. I checked this morning. It's not in there.
I felt like it was when I last looked. But anyway, what's not in there is 100 private tech companies.
No, it's got like 22, but it's got, as you said, capacity to get to them.
Yeah. It's also very expensive.
Some really exciting companies in there, like Impossible Foods has kind of fallen off, but like Axiom Space, Flexport, Epic Games,
But that doesn't explain why it's up 199%.
No, what does?
The fact
that 189%.
189. The fact that almost 40% of the portfolio is in SpaceX. And as we know, where Elon goes, his share prices go.
Yeah. This one conceptually makes so much more sense to me. Like, I think we've said it on the show a couple of times. The Tesla love, it's like there's like contradictory ideas. On one hand, it's like Elon and his Trump relationship. On the other hand, Trump and JD Vance hate electric vehicles. That one was always a bit confusing. This one is far less confusing. SpaceX is going to be a massive winner out of the Trump administration. Elon might privatize NASA in the next 2 years.
I know.
So SpaceX is going to get so much more government contracts. They're going to, that connection is going to pay.
I heard the other day he was sniffing around buying CNN.
Really?
Yeah.
Oh my God.
Anyway, that's the whole nother thing.
Yeah.
So 40% of the portfolio, and obviously the stock is up considerably. So
now, just one thing: if people are thinking about buying Destiny Tech 100, you called it an ETF. It's actually not an ETF. ETFs are open-ended.
Yes.
Their price tracks the asset value of the underlying asset. This is close-ended, similar to a LIC. Yeah, similar to a listed investment company if you're an Australian.
Yeah.
The price and the asset value underneath do not align.
No.
And they would argue it's because these are illiquid, irregularly priced things that only get priced at funding rounds. But the fact of the matter is, it trades at more than a 50% premium. So just be mindful about investing in this.
Buyer beware.
Yeah.
Now, if you want to keep up with the headlines outside of the podcast, make sure that you're subscribed to our daily newsletter where we'll send you headlines from around the world so that you are informed with everything that is going on, primarily with the Trump trade at the moment. So
No. We are not. This is not a Trump newsletter. The majority of the news is non-Trump related.
Oh, yeah, sure. Anyway. We love getting questions from the Equity Mates community, and we have another one here from Josh. Just before we get into it, if you would like to submit a question, there'll be a link in the show notes or description for you to leave a voice note. We'd love to get you on the show. But Ren, let's hear this one from Josh.
Hey guys, basically just wanted to get your thoughts on maybe like 5 to 10 books that you'd recommend on getting started investing. I'm a beginner myself and just would really like to have a few books to read and your recommendations on where to start. Thank you.
Love that, Josh. Reminded me of the first podcast we ever did
Okay.
with the birds in the background.
Yeah, for people unfamiliar with how Bryce and I started, it was outside on his balcony, one microphone between us for some reason, and a lot of background noise, cars and birds.
Yes.
We've come a long way from there. Now, look, when we get a question around what books, we generally split it up into sort of 3 categories. Best books for beginners, best general investing books, and then best business books. So maybe we cover off some of each. But we should say at the top, Josh, if you're looking for a great investing summer read, we've written 2 books, and some say we're biased, but I think I'm pretty impartial. I think they're the best starting point for you. Get Started Investing was really everything we learned over 6 or 7 years of doing Equity Mates and learning to invest, and it was everything we learned distilled into one book. And then our second book, Don't Stress, Just Invest, what we realized was that a lot of our mates, a lot of our family members wouldn't listen to our podcast, wouldn't read our book. They didn't want to become investors. They just wanted the benefit of it. So Don't Stress, Just Invest is the absolute simplest way you can set up your investments, automate it all, telling you exactly what to buy and what platforms to use, and then you can get on with your life. So 2 books, great place to start. But Bryce, aside from our books, what else do we think is a good place to start?
One of our favorites that we talk a lot about on the show is Millennial Money, How Young Investors Can Build a Fortune by Patrick O'Shaughnessy.
Yeah.
It's fantastic. It really walks through how you can, walks through the fundamentals, but then how you can really set up a portfolio to really just get on with your life and build meaningful wealth over time.
Yeah. There's a series of books called The Little Books, and I'm going to recommend 2 of them for beginners. The Little Book of Common Sense Investing by John Bogle. He was the founder of Vanguard, and that's a great place to start. And also The Little Book That Still Beats the Market by Joel Greenblatt. Both short reads, as the title suggests, but really, really good books by really, really good investors.
Now, if you're interested in then going a little bit deeper, the best investing books that we've come across early days for us in the journey, Ren, was Margin of Safety by Seth Klarman.
Hands down the best investing book I've read.
Yeah, we'll flick you the PDF.
No, we won't flick you the PDF. Please buy it. But if you just make sure you avoid the websites that host free PDFs of it.
Yeah.
Like, avoid them at all costs. Do not Google free PDF Margin of Safety. You need to avoid that.
Pay the $800 or whatever it is. And then the second one is actually from a guest we've had on the show a number of times, which is Roger Montgomery. He wrote a book called Valuable or Valuable.
Yeah.
Really good book in understanding the fundamentals of valuing a stock.
Yeah. Pretty straightforward way to do it. We don't give Aussie authors a lot of love, so we should give Roger some love. And then some business books to close it out, because I think, as much as you want to read investing-specific books to build the skills of investing, I think nothing is more valuable than understanding that you're actually becoming a part owner in businesses, and you need to understand how businesses operate and some of the success stories and some of the not success stories, some of the failures to understand what you're investing in. So what are some of the best business books you've read?
2 that I've read that I've just always recommend: Ride of a Lifetime, Bob Iger, CEO of Disney, and Shoe Dog.
Oh, yeah.
The story of Nike.
Yeah.
A lot of, that one's a real story of just like constant challenges and a lot of grit.
Yes.
And then a lot of luck.
Yeah. Yeah.
Classic business. What about you?
So if you're gonna talk about two positive stories that end on a good note,
I probably should have ended then.
I'll share two that aren't as positive because I think you can learn as much from the failures as from the successes. One that was a big failure was the book Lights Out, which is about GE. In 2000, it was the biggest company in the US, and the 20 years after that have just been a nightmare for the company. So that's a really good one. A lot of learnings from that. And also one that I really enjoyed, Caesar's Palace Coup, which was about the private equity takeover and then the battle between some of the biggest investment funds, some of the biggest distressed debt funds, and some of the biggest private equity funds in America over Caesar's Palace. It was a fascinating look at how that part of the market works.
All of those books will be recommended on our website. So we'll include a link in the show notes where we have a landing page for not only the books we've spoken about, but a lot more that we recommend for you on your investing journey.
Nice.
We're going to take a quick break, and on the other side, drum roll, we're bringing in Mr. Beat Up to talk about stocks that are down but not out. We will be right back. Welcome back to Equity Mates.
Mr. Beat Up.
Mr. Beat Up.
I have the beat that describes that moment accurately.
All right, we are super excited to welcome back to the studio Mr. Beat Up, or Simon. Simon, welcome.
Great to be here.
Now, if you've just joined the show for the first time, this is a segment where we bring Simon on, otherwise known as Mr. Beat Up, to talk about stocks that have been beaten down by the market, perhaps unfairly, and to walk us through why. And we've got a number to get through today.
We started with one and Simon snuck a few more in.
He sniffs that it's the last episode of the year, and so he wants to try and jam a bunch in.
All right, so just to remind everyone of the criteria, what we're talking about, the stock is down from all-time highs at least 30%, ideally more than 50%. But crucially, Mr. Beat Up, the second criteria is it's because of like a perceived issue that has largely been overreacted to.
Yeah, exactly. So we're looking for really that the stock price doesn't actually accurately reflect the long-term potential of the company anymore. Before we get into it, I just want to say thanks for getting the intro right, Mr. Beat Up. At a live event, someone did come up to me and say, Mr. Down and Out. They thought that was the name of the segment.
A lot of people also think it's Mr. Beat Down.
Yeah.
Mr. Beat Down. That sounds like a wrestler.
All right, well, Mr. Beat Down, what is on the short list?
We've had some great suggestions coming from the community. We had Domino's Pizza. They're down 80% against all-time highs. Obviously, a hot one at the moment, Min Resources. They're down about 60%. We all know what's going on there. But there was one that really piqued my interest, and I thought it definitely worth a mention. It's quite a spicy one, but it's Super Micro Computers.
Yeah, now, for those that have been with us for over a year, Super Micro might ring a bell because we actually covered it in last year's summer series when I think we'd just kicked off and it had jumped something ridiculous, a few 100%.
In the last 12 months, it's gone up 350%, down, 80%?
Yeah.
And so for the year, it's about down 10%.
Something like that.
Yeah.
So that's caught your attention. Very briefly, it's because it's been whacked by the short sellers Hindenburg.
No, well, okay, so hold on. Let's take a step back. That was the start. Hindenburg said there was accounting manipulation. There was a whole bunch of stuff going on. But since then, its auditor EY has refused to sign off on its accounts and has actually quit.
Yeah.
Just because it's unwilling to sign out. The Nasdaq, where Supermicro is listed, has given it until mid-November to file its annual report, and if it doesn't file, it may get booted off the Nasdaq. Like, there's a lot going wrong with this company.
So with
it hasn't been able to find another auditor to sign off on its accounts.
So with all of that in mind, Mr. Beta, why? This isn't the stock you bring to the table you just want to talk about.
Yeah, this is an honourable mention before we get into it. But I think, there's probably a good chance it does get delisted for a while. And it actually did get delisted in 2018 from the Nasdaq. So it's got history. It's got history. That was due to delaying filing its financial reports, audit issues again. Yeah, and with the issues outlined, no institutional investors want to touch it at the moment. They're preparing for it getting delisted. They're all running for the hills. So I think this just feels like an opportunity. Do your own research, but if you actually think they can overcome these short-term issues, they actually are a major player at the moment in data center computing solutions. Musk, that recent XAI data center he built that had Supermicro liquid cooling racks in there. So they're working at the top end. Like, the stock's currently trading at a forward PE ratio of 7. That's like an oil company's ratio, not a high growth tech company. So yeah, I'm not advising to go out and buy it, but do your research. If you want a proper beat up stock, this is probably the most beat up stock of the moment.
All right. Well, as we said, spicy. If it does get delisted, it may be harder to trade, but that is approach with caution. But what is the company that you want to talk to us?
Well, today I actually wanted to talk about a theme.
You're really getting as many companies as you can, aren't you? And the theme is
Nasdaq 100.
beating up companies.
I want to maximize this last session. So these are products that rarely go on sale, but this year the company's stocks are said to be in the clearance bin. And this, it's been a rough year for luxury goods stocks.
So that's the theme.
That's
luxury
the theme.
goods stocks.
How rough are we talking?
Well, the luxury industry had a pretty big boom after COVID, but it hasn't lasted. And if we look at how some of these brands are now doing against their all-time highs, I'll just run through a few here. So LVMH, they're the Louis Vuitton, Moet, Hennessy, down 35%. Christian Dior, down 40%. Kering, which is Gucci, down 70%. Burberry, down 70%. Capri Holdings, which Versace is probably their most well-known, 80% down from all-time highs. So it's been pretty brutal across the board.
So luxury, why is it down so much?
It's been a combination of a few factors. The main things, there's been a big pullback on luxury spending, predominantly in the US and especially in China. And those two markets, they're actually 50% of the global luxury market. We're also seeing some interesting shifts in consumer behavior. This is one I can definitely relate to, like millennial.
Stopped buying Gucci.
I've given up that habit.
I was getting ready to jump in. Like Gen Z's shopping behavior isn't affecting LVMH's customers.
Well, younger generations and millennials, Gen Zs, they're focusing more on experiences than material goods. So they're spending more on travels, which luxury brands actually compete with lifestyle spending like travel. So it's actually been seen as potential issue. And then, of course, there's high inflation interest rates globally. We've had the cost of living pressure. Discretionary spending's down, making people less likely to splurge on high-end goods.
Yeah, for me, it really feels like the China story.
Yeah, definitely. I think all the marginal demand is coming out of Asia.
Yeah.
Definitely. That's the main factor.
The point of this, though, is down but not out. So I guess if you had a look at, is there the opportunity here? What do we need to see for a bounce back?
Yeah, so I don't know if there'll be a bounce back, but I think if you look over the long term, luxury is here to stay. If you look at some of these brands like Louis Vuitton, Dior, for example, they've been around for over 100 years.
Yeah.
Think what we've had then: wars, recessions, major shifts in consumer trends. Like their cultural value and prestige, it doesn't just fade easily. No. And also, even during economic challenges, like there's still a lot of demand for these products from ultra wealthy who are less affected by economic fluctuations. And then you've got all the rising emerging markets, India, Middle East, Southeast Asia, Africa. There's a lot of new demand as people move into the middle classes and become wealthier. So I think, I might see these cyclical dips. The long-term outlook, I think, looks quite strong for luxury.
So I guess then when it comes to buying these companies, have you thought about the approach of either going down that brand, luxury goods ETF, or is it a pick the top of the market or the best in class? There is a few luxury ETFs out there. I wouldn't personally be looking at that. I think the quality varies too much between the brands.
It's not just the quality, it's also what's in the ETFs may not fit your definition of luxury. So one of the more famous ones is Lux, Lux. Pretty sure it's US, it would be US listed. Top of it, Hermes, Ferrari, LVMH, as expected. But in the top 10, Tesla, would you expect that? Royal Caribbean Cruises, would you expect that?
What? Really?
Yeah. Diageo, which obviously has some premium liquor brands, but I'm not sure if that fits my definition. Marriott and Hilton and Mercedes-Benz.
Yeah.
Like,
It's more of
okay.
a brand ETF.
Yeah,
than
we're stretching the definition of luxury.
Yeah.
It's funny you say Ferrari that because it's actually done the opposite compared to all of these, and which it's up. It's had a great 12 months.
Yeah, right. So not the luxury ETF. Do you have a stock of that?
Yeah. If you look at the strongest play in the sector, which probably could be picked up at good value during this downturn, for me, it's LVMH. Its fundamentals just make it stand up. So there's a lot to like about this company. I'll just share a few highlights. They are the powerhouse in luxury brands. 75 plus brands. They've got fashion, cosmetic, wines, whiskey, watches, you name it, they're there. Louis Vuitton, Dior, Fendi, Sephora, Veuve Clicquot, Bulgari. I could go on. So they're super diversified across different categories, different price points, different geographies. Morningstar, they actually say that LVMH have a wide economic moat.
Yeah.
So they basically say their market presence is nearly impossible to replicate, which gives them a competitive advantage. And if you compare that to, say, Kering, who owns Gucci, they've just got 16 brands. So you can kind of see the difference there in the portfolio. Also, what I really like is the Arnault family. They still own 47% of LVMH and control 65% of voting rights. So they're in control. And a big part of this is actually backing Bernard Arnault. So he's currently the 5th richest man in the world. It fluctuates a bit. He has been top before. I think with Elon's recent run, he's now top, but he's sometimes compared to the luxury version of Warren Buffett. And that's because of how he's built this huge conglomerate through acquisitions and capital allocation. But one thing I will say about that is, like Buffett, there are succession concerns. But Arnault, he's positioned his children in key leadership roles. This Frederick's now the CEO of the watch division. He's being touted at the moment as taking over. So that kind of suggests stability in his vision and how they're going to run things. Then finally, the last thing is just their financial strength. So their balance sheet is so strong that they can outspend rivals on marketing. They can allocate capital between the brands, which ones they see the trends and the best opportunity. And they also reinvest over half, so 53 cents of every dollar they make back into the business. And often they do that through these acquisitions. They bought Tiffany & Co., Off-White, Fendi, and that just then expands their brand portfolio further. But that also helps them take advantage of trends and defend their position in the market.
Love it.
Nice.
Pretty compelling.
That's the sales pitch.
So, Simo, one thing that has been asked in the YouTube comments especially is to talk to valuation.
Yes. Yeah. They're down 35% from their all-time highs, but they're actually up 50% over the last 5 years. So if you zoom out, they're actually not doing too bad. But a key thing you can look at is their price to earnings ratio is now around 20. And historically, over the last 20 years, it's been around 26.
Okay.
So if this is a company you like, after the recent drops, this is one of the more attractive entry points we've seen in a while.
Nice.
So I've done a quick DCF just if people really want the valuation work. I think so for the last 10 years, their earnings per share have grown at about 17%, 16.8% a year over the past 10 years. If you just said super simple, plug that in, just straight line that growth over the next 10 years, give it a 10% discount rate. Currently it's trading at about 570 euros a share. You get a fair value of around 800 euros a share. Yeah. And this is super high level. Like we've done no work in terms of what the actual growth rate will be. Yeah. But the other way you can approach a DCF is a reverse DCF, where you say that the outcome of the DCF is the current stock price, and then what is the required growth rate based on your discount rate to achieve that. So if we were to back it out and do a reverse DCF using a 10% discount rate, it's implying about 12% per year earnings per share growth over the next 10 years. So that's the question you have to ask. Is that realistic from where LVMH is now with its current share price? Can it get 12% a year profit growth over the next 10 years?
Doesn't feel unachievable.
It doesn't feel unachievable.
But it is very much tied to the China story. So that would be the thing that I would be looking at as its catalyst for turning around. But I mean, if you want to get an entry point,
just to give you the range of outcomes, like if you were to say, no, I don't think it's realistic, I think it'll get like inflation +1 or +2%. Let's say it grows at 5% a year over the next 10 years. Profit grows at 5% a year over the next 10 years. Then fair value comes in at around 360 euros. So it's massively overvalued.
Yeah.
So like that's the kind of the range of outcomes you're looking at.
Yeah.
But I think, Simo, based on its historic growth and everything you said, like it's certainly worth a look.
Definitely worth a look.
Yeah. Well, this one feels probably most compelling. This one doesn't feel like an overreaction from the market, but it just feels like a nice story of
maybe coming back
opportunity.
to fair value. So if it's a company you like, now could be a chance.
Yes. Now, we should close by saying that we actually asked Luke Larrative, one of the advisors that we get on the show, for his single long-term stock pick. I think if we said for the next 30 years, you could only choose one stock.
Yeah.
And he actually said LVMH.
Yeah, he wasn't happy with giving just one stock.
He's never happy. Thank you, Mr. Beat Up, for coming in. Final episode of the year. It's been an awesome year. Looking forward to getting you back in 2025.
Yeah.
If you have any stocks that you think Mr. Beat Up should be adding to the watch list, make sure you send them through. You can hit us up on Instagram. Mr. Beat Up's active on YouTube, or you can hit us up at equitymates.com/contact. We'd love to hear from you.
And look, if you're looking for more investing content before Mr. Beat Up joins us back on Equity Mates, head over to Get Started Investing. The episode that's coming out tomorrow, Bryce and I share 5 timeless investing rules you need to know. So head over there wherever you're listening to this podcast. But Bryce, that'll do us for today.
Love it. Thank you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.